Enron's story is one of the most infamous corporate scandals in modern history, representing both the dangers of unchecked corporate ambition and the failures of regulatory oversight. Founded in 1985 through the merger of Houston Natural Gas and Internorth, Enron initially operated as a traditional energy company, dealing with the supply and distribution of electricity and natural gas. Under the leadership of CEO Kenneth Lay, the company initially focused on pipelines and energy distribution, but as the deregulation of energy markets began in the 1990s, Enron sought to transform itself into a trading powerhouse. The company's stated goal was to innovate within the energy sector, and it began trading energy contracts, derivatives, and other complex financial products. These moves allowed Enron to appear innovative and extremely profitable, creating immense hype around its stock. Jeff Skilling, who joined Enron in the late 1980s and became CEO in 2001, was instrumental in reshaping the company's culture. He introduced a model called mark-to-market accounting, which allowed the company to record projected future profits from long-term contracts immediately as revenue. While this accounting method is legitimate in certain contexts, Enron abused it to report profits that did not exist in reality. For example, if Enron signed a 20-year energy supply contract, it would immediately claim the expected profits from that contract as current revenue, even if no money had been received. This gave the illusion of explosive growth and profitability. As a result, while Enron appeared to be a $63 billion company, much of its value was illusory, based on paper profits and complex financial maneuvers rather than tangible business operations. One of the company's key fraudulent strategies involved the creation of special purpose entities, SPEs, which are legally separate companies used for off-balance sheet transactions. Enron used these SPEs to hide massive amounts of debt and failing investments from its main financial statements. By transferring underperforming assets and liabilities to these off-balance sheet entities, Enron was able to maintain a healthy-looking balance sheet while concealing growing financial problems. This deception allowed the company to continue borrowing, trading, and expanding without the scrutiny that would normally accompany such financial strain. SPEs were presented to investors as independent ventures, masking the extent to which Enron remained responsible for their debts. Enron also exploited the energy market itself to create the appearance of demand and profit. The company engaged in questionable trading practices, including manipulating energy prices in regions such as California. Through schemes that included artificially constraining energy supply and engaging in circular trades, Enron created false market signals that benefited its trading operations. While these practices generated short-term profits and impressed Wall Street analysts, they had real-world consequences, including massive energy price hikes and blackouts, which harmed consumers and attracted regulatory attention. The hype around Enron stock made the company appear to be a model of success, attracting high-profile investors, analysts, and financial media attention. Enron was hailed as a pioneer, and its stock price soared to over $90 per share at its peak. Employees eagerly invested their retirement savings in Enron stock, believing that the company's growth would continue indefinitely. However, beneath this facade, the company's financial health was deteriorating rapidly. Its reported earnings were inflated, its balance sheet was obscured by off-balance sheet debt, and its underlying business model was unsustainable. The complexity of Enron's financial statements made it nearly impossible for investors to understand the true risks. Warnings about Enron's practices did exist, but they were largely ignored or dismissed by analysts and auditors. Arthur Andersen, Enron's accounting firm, was supposed to provide oversight and ensure transparency, yet it failed to report the company's fraudulent activities. In fact, Andersen was complicit in helping structure transactions to hide losses and mislead investors. This conflict of interest, where the same firm provided both auditing and consulting services to Enron, created an environment in which unethical behavior could flourish without checks and balances. As long as the stock price continued to rise, both management and auditors had little incentive to reveal the truth. By 2001, cracks in Enron's facade began to show. Analysts and journalists started questioning the company's accounting methods and the legitimacy of its reported profits. In October 2001, Enron announced a massive $618 million reduction in earnings, revealing that it had been overstating profits for years. This disclosure caused panic among investors and triggered a rapid decline in stock price. As confidence evaporated, lenders demanded repayment, credit lines were withdrawn, and the company's liquidity crisis became undeniable. Within months, Enron's market capitalization, which had been $63 billion at its peak, had essentially evaporated, and the company filed for bankruptcy in December 2001. The collapse of Enron had far-reaching consequences. Thousands of employees lost their jobs and saw their retirement savings wiped out, as they had been heavily invested in company stock. Shareholders lost billions of dollars. The scandal also exposed weaknesses in corporate governance, auditing practices, and regulatory oversight. Government to introduce stricter regulations, most notably the Sarbanes-Oxley Act of 2002, which increased corporate accountability, improved financial disclosure, and imposed harsher penalties for fraud. The law sought to prevent similar disasters by ensuring that executives and auditors could not conceal financial problems or mislead investors without severe consequences. Enron's leaders, including Kenneth Lay and Jeffrey Skilling, were eventually prosecuted for fraud, conspiracy, and other crimes. Skilling was sentenced to 24 years in prison, though it was later reduced, and Lay died before sentencing. Arthur Andersen, once one of the Big Five accounting firms, was effectively dissolved due to its role in the scandal. The Enron collapse became a cautionary tale, symbolizing how corporate greed, lack of transparency, and regulatory failure can combine to create one of the largest financial disasters in history. Beyond the immediate financial and legal consequences, Enron's story had a cultural impact. It influenced how investors and the public perceive corporate ethics, and it underscored the importance of transparency, accountability, and skepticism. Financial markets became more cautious, analysts began scrutinizing companies more carefully, and corporate governance standards were elevated globally. Enron demonstrated that the perception of wealth and success can be entirely fabricated if proper checks are not in place, and that unchecked corporate culture can lead to catastrophic consequences. The Enron scandal also highlighted the dangers of complex financial instruments and aggressive accounting techniques.